hard. You send that 8-minute voice, don't straight from the heart. I reply like, yo, whatever. When can you come get your stuff? I need this shit out the crib. I think it's bringing bad luck. Plug in, now you're lit. I pull the plug, now you're stuck. Dignity over a nut. Weak man all in the cut. How many doors are they shut? How many feathers they pluck?
What is going on, guys? Welcome back to my YouTube channel. I know it's been a couple months since I've posted, but I've been busy with other projects, other businesses that I run, and unfortunately I'm not a full-time YouTuber. However, I will try to post as much as possible. I'm going to try to get back to filming just more day in the life stuff when I'm taking trades throughout the day, and behind the scenes of my other streams of income and my other businesses as well, because that might interest a lot of you who are watching. So the title of this video obviously is how I lost 400k of live capital with Alpha Capital Group. Now, this video isn't me slandering Alpha Capital Group. They're a great firm. Believe it or not, I actually made a mistake, which was the reason why I lost the 400k capital. So first and foremost, I have received payouts from Alpha Capital Group, multiple payouts. So I'm very profitable from that business venture that when I was trading with them. However, what happened was I got a violation on the account. Now, I'll let you guys make a decision on what you think of this violation, but I'll put up the email that I received. And basically, it's like a max allocation. It's like a max allocation violation, which means basically in their rules, like I said, I hold my hands up. At the end of the day, it's a rule, right? It's something that was broken. But yeah, we'll talk about it. So the max allocation, you can't trade the same asset pair on two different accounts once you're live. Okay, so I had two 200k accounts. I couldn't trade Euro USD on one, for example, and then Euro USD on the other. That is a violation. But this is where I want to get your guys' opinion, and make sure you put it into the comment section. So, funnily enough, I didn't actually trade two different asset pairs. What happened was I had my first 200k live account with Alpha Capital Group. I was trading on that using Euro USD and other pairs. Then when I got my other 200k live account, I placed a 0.01 lot on Euro USD once, just to get a trading day. As you guys who trade prop firms probably know, you've probably done the same thing, just to get the trading days ticking along so I can get a payout when I actually do decide to trade it. So I placed a 0.01 on Euro USD, and then the other main trades where I was doing over 20 lots or whatever it may be on other currency pairs. For my main trades, I use different asset classes. So I just want you guys to take a minute to think about that. Now, you need to really think about what you're doing with these prop firms, because you're thinking that, or I hope you don't, but you think that these prop firms want good, profitable traders. I'm telling you now that they don't. This is the reason for that. Because I'm a good trader, I've had multiple payouts with the firm. Why would they take an account of me for doing that? Now, I know it's a violation. I know it's in the rules, right? I'm holding my hands up to that. Because at the end of the day, if it went to court, they'd obviously win. They have that rule in there. But ask yourself, do they have that rule in there to help traders, or do they have that rule in there to stop profitable traders, to catch you out where they can? Just think about that for a second. And for those of you who don't know, prop firms make money, or make their money from people losing. They make their money from the challenge fee. They lose money by paying out profitable traders. So obviously they don't want profitable traders. Now, the only reason they want profitable traders, or some profitable traders at least, at max, is because it's good for their marketing. Obviously, if you're going to be choosing a prop firm to go with. Obviously, you want to go with a prop firm who has paid out to traders, who has never denied a payout, and all of this stuff. So they have to use that. That's their marketing expense. Okay, they have to pay out, because otherwise no one's going to go to the firm, right? But just think for a second, okay? These prop firms only make money from people losing, and 99%, probably more, 99.5% of people will lose on their platform. So yeah, you got to ask yourself, there's people out there, if you're watching this video, if you think you're going to have a long, sustainable career just solely trading prop firms, you need to seriously reconsider, because any minor fault, okay, that you make, any small, fault that you might make, which doesn't technically make you a bad trader, okay? Guys, you tell me in the comment sections, is what I done, does it make me a bad trader? Why didn't they thoroughly review the account, see that I've been making consistent profits before this, made a small mistake which goes against their rule, pays a 0.01, to then ban me? Do they actually want good traders on their platform? So really consider that. I've had multiple people as well come to me and message me and say that they've had their accounts taken off them for stupid reasons. So just think about it, guys. And so if you're going for prop firms alone, I hate to be the bearer of bad news, I hate to be the one to tell you this, but it's not going to be sustainable. Okay, yes, it's a great way to make some cash, to make some returns, but it's not sustainable in the long term. You're not going to see a career just trading prop firms. I don't know one good trader who has just consistently been with a prop firm forever, making a living off just that alone. It's a great business model, and I'm not slandering any prop firm, but I'm just saying be careful, because all prop firms are the same. They don't want winning traders on their platform. Okay, and it's quite funny actually, because when you take a step back and you look at the logistics and the statistics of what is actually happening in this market, everyone is praising FTMO or praising Alpha Capital or praising the prop firms that are paying out. These prop firms are only able to pay out because they have the most amount of losing traders on their platform. So you're praising prop firms who have the most amount of people losing money. Okay, that's the reason prop firms are able to pay out, because they have lots of people on their platform who are losing money, which they are then able to then pay out their winning traders. Think about it, 99% of people, right? If they all buy a challenge for £1,000, they are making £99,000. The prop firm, one person gets a payout, they have £99,000 to ensure that the profitable trader doesn't get paid out £99,000, which they probably won't. They'll probably get paid out a few thousand, hence why they're keeping all the rest of the profits, hence why FTMO and all these people are buying amazing offices and doing all these things. They're doing that with your money that you're losing, okay? Just remember that. So yeah, don't want to ramble on too much, but I will continue to talk about these certain things in videos, just because I'm trying to be real with you, I'm trying to be honest with you. And yes, I do trade prop firms because I'm good, but I know that I know it's not sustainable, because they don't like people like me that make money. They will find a reason not to. And yeah, guys, you need to have multiple sources of income. You can't just be trading prop firms, every single week you're buying a new prop firm. I promise you now, it's not actually going to get you anywhere. You need to be diversifying your wealth. You need to be diversifying what you're essentially doing. You need to be trading live capital, your own capital. You need to be doing prop firms. You need to be running other things, other businesses. I do not know one trader, even myself, whose sole income is just trading prop firms or trading even just live capital. Okay, and we'll talk about that later on, but you have to have other sources of income, because trading is a high risk industry. No matter how good you are, it's still high risk. You can still lose all your money. The markets can still turn against you whenever they want. There's no security. So you've got to limit that risk by diversifying what you're doing across multiple different avenues. Within the trading space is fine, but just multiple different ways to really mitigate that risk and that exposure that you have. But anyway, guys, I have just pulled into the office and I'm going to be breaking down as well for you guys a trade that was taken this week for plus 7.5 risk to reward, and then also a break-even trade because it's got some really, really nice price action that I want to talk to you guys about and hopefully help you guys with your trading, because I owe it to you guys for not being active for a couple months. And then after, I'm going to go back home, just relax, answer maybe a couple questions from you guys in the comment sections from my last video, and then I am pretty much just going to be relaxing because it's Friday. Got my girlfriend coming around tonight, and then just going to be doing absolutely nothing, just chilling. So yeah, guys, I'm just pulling up to the office now and we'll head straight on to the computer.
Pulitzer Prize winner is definitely spiraling. I got your fucking lines tapped, I swear that I'm dialed in. First I was a rat, so where's the proof of the trial then? Where's the paperwork of the cabinet is filed in?
So I just briefly want to explain a bit further about what I was just speaking about on the way into the office, because I know it's probably left a lot of you thinking, well, what do I do then? Do I trade prop firms? Do I not trade prop firms? I know a lot of you are thinking to use prop firms as a way to get a payout to then fund your live account to trade with, your own personal live account. And I'm not saying don't trade prop firms. I'm just saying be careful and be mindful of the statistics and the probabilities associated with prop firms. Okay, you need to understand that the probability of you passing a challenge is extremely low. You need to understand that passing a challenge, getting to a live account and getting consistent payouts is very, very, very low. And the probability of you eventually losing that account, from a mistake that you've made, or if a prop firm goes down, is extremely, extremely high. Okay, so I'm not saying don't trade prop firms. I'm just saying be more mindful, because it's a great business model and it's enticed retail traders to come into this space purely because they're the ones who are being targeted, because they don't have the capital to trade with. So you're focusing on the reward rather than the risk. Okay, you're thinking about getting a 100k live account, 200k live account. You're thinking of the potential profits, the amazing profits that you can make, the amazing opportunity that it might have, but you're not considering the risks to do so. Like anything in life, guys, when something is that amazing, it's going to come at a price. Okay, think about the statistics, think about the probabilities that you're getting yourself into. Make sure you're not just putting all your eggs into one basket. You're diversifying, what you're doing within the industry. You're trading a live account, you're trading prop firms, you're doing multiple different things rather than just going to prop firms, because you're really decreasing your probability of being successful by just focusing on one thing that has a very low probability of you being successful in it. And just take a minute to think about what you're actually getting from these prop firms. Okay, what are you actually getting from them? When you go to Apple, for example, you give Apple money, you're getting an iPhone in return. You go to Lamborghini, you give them money, you're getting a beautiful car in return. With these prop firms, you're giving them money, you're getting absolutely nothing in return. Okay, yes, a few people pass, they get a demo account to potentially make profits on, but think about it, you're not really getting much in return from it. And when you're going to these events that they're holding, or you're praising them, on social media, just remember that they have your money that you have nothing in return for. Okay, if you sit in a room, there's 100 of you in a room at one of their events, they want most of you to fail. They have most of your money and they only want a few of you to pass and get payouts, so they can use it for marketing purposes to bring in another 100 people, and so on and so forth. So yeah, guys, I'm not saying don't trade prop firms. I don't want to crush your dreams, but I just want to bring you back down to earth, back down to reality a little bit, because it seems like the industry's gone a bit all over the place recently. So I'm just trying to help. And yeah, just be careful, be mindful of everything. Always consider the risk before the reward. But now we're going to go into some charts. We're going to break it down, and then after that, head home and answer some questions from you guys. Okay guys, so here we are on CAD JPY. This was a position that was taken this week on the lower time frames. Managed to bank 7.5 risk to reward on this. A lot more potential. This actually hit my trailing stop loss, which we'll go into. But first of all, I'll just break down the analysis and then we'll get into the actual entry itself. So originally we can see how price is moving to the downside, right? We're forming lower lows followed by lower highs. So clearly sellers are in control of the market until price failed to continue to the downside. And we had this strong push, breaking market structure, breaking through the highs. Okay. And then price formed an inverse head and shoulders pattern with the left shoulder over here, down here being the head, and then down here being the right shoulder as well. So this is the inverse head and shoulders pattern, which is a bullish reversal pattern. It basically is just a fancy name for telling us that price action is switching from bearish market structure to bullish market structure, as we're now forming higher highs followed by higher lows. However, we're not looking to trade the right shoulder in this instance because we haven't really seen a strong enough impulse move to the upside to clearly state and clearly show that buyers are in control of the market. And that's why we waited for this move to take place here, because as you can see, that is as clear as anything, right? That is clear, strong bullish move to the upside. We should be looking for buy positions, okay? There's nothing now in the way for us really to be looking for anything other than buy positions. And then we can see how price pulled back, okay? Pulled back to retest. I was expecting originally price to come down to here, but as you can see, instead we looked and we saw how price has retested the top of this wick over here, which is completely fine. But what I'm not doing is I'm not taking a buy position right from the bottom of this. Okay, I'm not taking a position there. I'm actually jumping down to the lower time frames, such as the 5 minute and the 1 minute, to see a shift in market structure on this retest here. So that's what we're going to do. We're going to go down to the 5 minute time frame, and this is where we get the pullback here in a bit more detail. So like how we had on the 15 minute time frame, how we was moving to the downside, we can see again on the 5 minute time frame. It's not as clear, but we are definitely moving to the downside, forming lower lows followed by lower highs. And then rather than continuing to the downside, what we had was a shift in market structure on this lower time frame, as you can see with this strong impulse move here. So now we're just on the lower time frames doing the exact same thing we've done on the 15 minute time frame, and that is the key. Okay, we're jumping down to every single time frame, seeing that shift in market structure, getting rid of any blocks in the way that might give a reason for sellers to want to be in the market. We just want as much confirmation to give us our edge and to give us the probability of price continuing to the upside. So originally this happened, this is like a nice retest, as you can see here. Resistance, we broke through, we pulled back, and then we retested it as support. Now this was about 8 a.m. in the morning. I wasn't on the charts at this time. Sometimes I am, sometimes I'm not. If I was on the charts at this time, I probably would have taken a buy position here, but you know, it's all good saying shoulda, woulda, coulda, but I wasn't there. I didn't take it, so it is what it is. But for anyone watching, that would have been also fine position to take. Then we had a nice another impulsive move to the upside, okay, and then price began to pull back, and I was looking for price to like pull back to this area here, which we can see it was doing, but this whole movement here is very, very choppy, very, very corrective, and it's hard to really tell what's going on this 5 minute time frame. So this is where I will drop down to the 1 minute to get a more clear view of what is actually going on. So originally on this 1 minute time frame, you can kind of see how, let me just make this a bit more clear. You can kind of see how it might fool some people, because we did have a strong bearish move here, which broke below like these lows here. And then we actually started to form bearish market structure where we was doing this, forming lower lows, lower highs, lower lows, lower highs, so on and so forth. But look at the phase of the market. This is a strong bearish impulsive move. If price was going to continue moving to the downside, we'd expect to see a correction to the upside like this, followed by a bearish continuation. But as you can see, we actually began to form a bearish correction. So sellers aren't really active in this market if they're correcting to the downside. And as we know, what normally tends to follow a bearish correction. If we draw it out like this, bearish correction is a bullish continuation like so. So it was just fueling, building up liquidity to then continue to the upside. And that's exactly what happened down here. Notice this area of support, okay, where we have 1, 2, and 3 touches, potentially even 4 touches of this support. Now, what I like to call this is a retail trap. It's enticing retail traders to enter the market too early because they've learned that they need to buy from support. They need to buy from support, right? So they are entering their buy positions at all of these levels here. Like that would be the first one. And then they would also be buying the market there. They would be buying the market there, so on and so forth. So what does this mean? This means that all of their stop losses are below this level of support. And that is what the market sees. The market sees these areas of liquidity to grab into, to stop people out, to then continue to the upside. And that's exactly what happened here. Price impulse to the downside, grabbing liquidity. We then saw a shift in momentum. So that is where I took my position. I was patient. I waited for this area of support to be taken out. It's taken out. I then take my buy position, and then we will see what happens next. Stop loss in a pretty safe space as well. So we started moving to the upside. Now, I haven't trailed my stop loss at this point. Reason for that is because I'm waiting for this market structure to be broken. This most recent lower high, I'm waiting for that to be broken, because once that's broken, then I'm happy to trail my stop loss to break even, because it means that price is now bullish. So I want to protect my capital because it's bullish now. So I don't want to see it turn into a loss. Right now, it's still developing. We still could come down a little bit before we go up. So let's see what happens. We come back down, we form a double bottom. Okay, so could have been a nice opportunity to get into the market again if you missed it here. Or if, let's say, for example, I did, or anyone did trail their stop loss to break even and get stopped out here, what most people would do is they would just leave the charts alone. They would just, okay, it's break even, they close down the charts. I would still be observing it. If it just rejects this level again, I would just re-enter the market again at that level. But anyway, now we had this strong impulsive move to the upside here, breaking market structure. At this point, I've trailed my stop loss to break even. Not only that, but I'm looking for a scale in position. I'm looking to enter another position where, as if you guys know, I'm not a set and forget trader. I am someone who enters, manages, scales in, increases their chance of high risk to reward trades by scaling into more positions, if that makes sense. So I was looking for price to, after it's broken, to pull back to this level to then continue, okay? So I'm observing the market, and that's exactly what happened there, which you can see. We had a nice rejection from this zone. I entered another position. Now, one thing to note is this isn't my target, okay? This is just where I got stopped out at for my trading stop. I was originally targeting this level up here, which we had. So it would have been a crazy risk to reward ratio, as you could have seen. But if you guys have been watching how I trade, I tend to set very, very high take profit levels because I don't like to be limited with my trades. If I catch the trend nicely, I want to let that run as far as possible. Now, that's not being greedy, because what I do is I trail my stop loss with price action. But I'm just giving price room to breathe, because if you catch the trend sometimes, which I have done, you can catch really, really incredible risk to reward ratios. Because I'm that person, when I'm right, I want to be right big. I don't want to put in all this work to just get a small risk to reward ratio. Anyway, so second position was entered. I think we went into nice profits, as you can see there. Now at this point here, this is where I began to trail my stop loss. I trailed it to here, this one being a 1 to 3, this one being at a 1 to 4.5. I trailed it to just below this level here because I was happy with the profits. And yeah, that's pretty much it. I was happy with where it was, and I was expecting price to continue. But as you can see, we came back down and I got stopped out in a trailing stop loss. But then as you can see after this, price was very, very choppy. Okay, now I do not want to be in a market that looks like this. Something is coming. When the market is moving like this, it just means there's not many traders active within the market. And there's a reason for that, which you'll see in a second. because there was a big move, probably because of news. Well, it was because of news that took place, which was the reason why price was so choppy throughout the day, throughout the afternoon. There you go. So why did we have that move? If you actually look, if I jump back up to the 15-minute time frame, you'll see what happened. Price pulled back to retest our original area in the market of the neckline, to retest it as an area of support. Now, this was at 7 o'clock at night, so I wasn't actually trading, and it was just after news, so I probably wouldn't have traded anyway. But yeah, as you can see, it would have been a very, very nice position. The price action was great, and I believe we did just continue moving to the upside after this. Yeah, price just continued growing. So the direction was right. We understood that price was bullish. We just got in at a time where the price was very, very choppy. However, we did still manage to capitalize it. A plus 7.5 risk to reward is a great risk to reward. The potential could have been a lot more, but either way, we managed to find our position. We managed to enter it well, scale in, manage it well, trail our stop losses well. And that's the most important part. The easy part is getting the bias, right? It's very easy to determine whether a price is bullish or bearish. The hard part is actually entering the market and then also being able to manage that trade with strict risk management and strong discipline as well. So yeah, that was CAD JPY. I'm now also going to talk about a position that was taken on Euro JPY because the market structure is great. It was a break-even trade, but it'll be nice to show you guys a position on it. So yeah, let's go straight into Euro JPY. Right guys, so this position is on Euro JPY. This is the 1 minute time frame. I'm just going to start on the 1 minute time frame because this is where the price action is the cleanest. Starting off, once again, we're looking at the direction, we're looking at the bias, and we can see that price was moving to the upside, forming these higher highs, followed by higher lows, retesting support, and then rather than continuing to the upside, we had a strong bearish move to the downside here. Strong bearish move to the downside, breaking market structure, breaking through key levels here within the market, okay? So that has broken market structure, so I'm now looking for sell positions. However, I was waiting for this level to be broken because I was seeing a head and shoulders pattern that was formed, so I wanted to wait for the neckline to be broken, okay? This is the left shoulder, up here is the head, and over here we can say is the right shoulder. Also look at the phases of the market, okay? Strong bearish impulsive move followed by that bullish correction which we've been talking about, and then we have the continuation to the downside which forms a new lower low. And this right here, this move in the market is our confirmation because we are in bearish market structure. We've also broken the neckline of the head and shoulders pattern, so there's nothing in our way really to not be taking sell positions. Price pulled back nicely to this level here and we started to see a rejection, so I took my sell position, my stops above the high point, aiming down here for like a nice 1 to 4 risk to reward, and then we'll see what happened. Initially there we had a nice move to the downside, breaking this little low point here, so I trailed my stop loss to break even on this one, and then as you can see got stopped out at break even, not a loss, and then we went back up. Good thing I did move to break even because it would have been a loss. And then as you can see what happened after this, price went down exactly to our level that we were targeting down here, and then it obviously went up, but that was a good position that we could have taken. And this just goes to show, right guys, sometimes when you get stopped out, how many times do you get stopped out and then price goes in your direction anyway? You know, you get stopped out by a couple pips or break even and then it goes in your direction. I am someone who takes a lot of trades because there's a lot of opportunity, and I would rather take the risk than lose the chance. So if that means decreasing my risk per trade so I can take more of them, absolutely fine. But I'm not a believer in, oh, you know, I've taken 2 losses, 3 losses today, so I'm going to call it a day. What if the 4th or 5th trade you take is a massive risk to reward and you're just not taking it because you've taken too many losses? If you've taken losses because it didn't fit to your plan, then that's something you should definitely cut out. But if you're sticking to your plan and you're taking positions, just take, in my opinion, I just take the trades anyway, because most of the time you're not going to get it on the first go or the second go. Look here, right? Price likes to grab liquidity. We pull back, we break the high again. We don't come down this time. We break the high again. Third time, we come back down. Same thing happened here. Look, one time, we don't come down. Second time, we don't come down. Third time, we finally come down. What if on each of these times you take 2 losses but don't take the third? You've missed out on 2 good trades out of 6. Rather than taking 4 losses, you take 4 losses, but you also caught 2 massive, like, big trades. So something to consider with that. Let me try and think if there's anything else to discuss. I don't believe so, guys. I think that is pretty much it. Just a quick one on Euro JPY. Also, why I didn't take that position, I didn't actually take it. It's just because I wasn't on the charts. I set this one to break even. I had to leave. I had other things to do. And I didn't actually take that. But if I would have definitely taken that. But it is what it is. You know, you miss winning trades, you miss losing trades. It's swings and roundabouts. It's a long-term game we're in. You know, it's not about the next 10 trades. It's about the next 1,000 trades that you take. So, yeah. And how do you know when to basically give up? Because, you know, what if it's, you know, 1, 2, 3, 4, like it just keeps going and then you take like so many losses. You want to be able to limit it, obviously, to a certain extent. You don't want to be taking like 6 trades in a row. You need to limit it to what your risk to reward ratio is. What I mean by that is, can't speak today, guys. If your risk to reward ratio averages at around like a 1 to 3 or 1 to 4, then you shouldn't be taking more than 3 to 4 trades on that setup, because then you're not making back your losses. If you're someone who catches 1 to 5s or 1 to 6s, then you can afford to take 5 or 6 losses on a single setup before you finally catch your winning trade. So it all depends on your average risk to reward ratio. So yeah, and eventually, say for example, price comes down and it's doing this, it's still correcting. That's fine to take positions on. But then if we have like a nice an impulse to the upside, I wouldn't then still be taking positions to the downside. I still would just want it to be corrective. But yeah, guys, that was long, but I hope that was helpful to you. Like I said, I owe you guys some breakdowns and stuff like that. But yeah, listen, I'm gonna head back home. I'm gonna try and answer a few questions from you guys. And if you want to join my group, by the way, where I send all my trades all the time, be sure to just click the link in the description, or on my Instagram. I've got a link there. Make sure you're subscribed to the channel, by the way, guys. I don't know if I've mentioned that yet. And make sure you're following my Instagram. Make sure you're liking everything and sharing it. Because yeah, I'm going to be trying to post as much as possible. But yeah, I'm going to head home now, and I will see you guys there and answer all of your questions. So I'm back at my apartment now, and like I said, I'm going to answer just 1 or 2 questions from you guys that you left in my previous video. And going forward, if you do have any questions, just leave it in the comment section and I'll try to answer as many as possible. So before I answer some questions, I just want to briefly touch on one of the services that I offer. It's completely hands-free automated trading using an algorithm which has been developed by a great team of developers. Now, to join this, you only need a minimum of $500. There's a proven, verified track record of the results. So I'll leave a link in the description and obviously on my page on Instagram if you want to join. Click it, fill out your details, and if you pass the application, I will personally contact you on WhatsApp and we can talk about it. You can ask me any questions that you have. It's free to join. You just need obviously money to trade with. It's live accounts as well. It's not prop firm accounts. But yeah, you will be talking to me personally, don't worry. But yeah, that's all I wanted to mention. And also I'll just show you, I'll put the link or like a screen recording on the screen because I won't be able to show you here, but we're currently testing the system with an investor from Dubai who has started the account with 70K. If I just scroll up here, you'll be able to see that he started with 70K, and this was only last week and he's already made over 1,000 on the account. So he is testing it currently with just 70K, and then if he likes the results, he's actually going to deposit quite a large amount. So I'll keep you updated with that if it happens, obviously, but it might go through more testing. But you know, you're going to be getting access to the same algorithm that this person is using, that I'm using, that everyone around me is also using. So yeah, like I said, proof is in the pudding. But yeah, if you want to join, just click the link and I will be in contact with you. Right, so now to the questions. Someone put on my last video, his name is Relatable Edits 99. Brother, I'm using your trading strategy. Should I trade all currency pairs or focus on just one or two pairs? Please let me know. Now, this is a great question, and really it's going to take a lot of explaining, but I'll try to keep it as brief as possible. So basically, there's no right or wrong answer. It's truly what you are comfortable with trading. Now, there's pros and cons to both. There's pros and cons to just trading one currency pair. There's pros and cons to trading 10 currency pairs. Let's quickly talk about it. So if you're trading just one currency pair, okay, then you're limited to that pair. You're not going to get as many trading positions on that pair, which might lead to mistakes. It might lead you to forced trades because you're not finding the right positions on that one currency pair. It might go through a couple of weeks of really, really bad market structure. But because you're only trading one currency pair or currency pairs with the same base or quote currency, for example, only JPY pairs, if you're only trading JPY pairs, then if the Japanese yen is not moving nice for multiple weeks and that's your only currency pairs you're trading, you're going to be forced to make stupid mistakes, make silly mistakes, trade market structure that you're not used to trading. So that's a con of only trading or only trading one pair or two pairs or the same currency. Now, a pro to it obviously is that you won't get overwhelmed, because when you're trading too many currency pairs, you're not really mastering the pairs. You're not really understanding the price action. When you're trading currency pairs in your watch list, you need to know exactly what is happening on those currency pairs. For example, I should be able to ask you, if you're trading Euro USD, I should be able to ask you, okay, how did Euro USD move last week? How is it currently moving? You should be able to answer that. You should know it like the back of your hands. So that limits you to just know maybe 5 or 6 pairs that aren't correlated. So maybe just trade one USD pair, one JPY pair, one NZD pair, one Euro pair, one GBP pair, something like that. So you're trading multiple pairs, but you're only trading one currency pair with each individual asset. Okay, that way you're not trading too many where you get overwhelmed and you're jumping between charts and over trading and not really mastering anything, but you're still limiting it to a certain amount where if one currency pair isn't moving how you want it to be moving, you can put it aside and then you can trade the other ones or the one that is moving how you want it to move. That's what I do. I trade maybe 6 or 7 pairs. Then on the exact trading day, for example, on the Tuesday, I will look through all of those 7 and I will maybe choose 1 or 2 depending on the market structure. If it's moving nice, if it's not moving nice, I will pick the one to trade on that specific day. I'm not actually focusing on all 7 currency pairs on the day. I will just focus on a set few that is moving how I want it to be moving. I'm not going to focus on anything else. Even if I miss opportunities, I don't want to overwhelm myself, jump in between screens, jump in between tabs on my computer. I just keep it really, really simple. And because I trade lower time frames as well, like the 1 minute, the 5 minute, there's plenty of opportunities throughout the day to maximize on that as much as possible. So yeah, I could probably go into a lot more detail, but that's about it. Yeah, I'll answer another question as well. So let me just find one and I'll get back to you guys. Right, so Rickson's I don't know what that says. Anyway, he has put, hello bro, I'm having watched those ICT channels, but I'm confused a lot. Does those things, order block, breaker block, FVG matter in trading? I have backtest, but I'm confused into apply in real chart. Completely understand what you're saying. So first things first, when I started trading 8 years ago, things like smart money concept, breaker blocks, I don't know, FVGs and, all these other stuff, London kill zones, they were never a thing when I started trading. I think people have just kind of brought out special names for different things, because like a fair value gap is just a name for something that happens within the market. It's just called something. okay? It's a name, like how a Head and Shoulders is called a Head and Shoulders pattern. It's not a Head and Shoulders. A Head and Shoulders pattern is telling us that price is moving from bullish market structure to bearish market structure. So don't get confused with all the names. I'm not telling you that these things aren't good, because they probably are, but understand that they just have a deeper meaning behind it. And you're not looking for the name, you're not looking for a fair value gap, you're looking for what actually a fair value gap is. I don't actually trade fair value gaps or anything like that. I trade pure price action. I literally, to be honest, never really draw too much on my charts, because in my opinion, the closest you're ever going to get to the future of price action is price action itself. The closest you're ever going to get is price. So the more you put on the charts, the more you lag, the indicators you use and all these things, really and truly, you should just be able to look at that chart and understand what is going on. Is it bullish? Is it bearish? Because back in the day when people were trading, before TradingView and all these online things were a thing, it was just numbers on a screen, okay? It was just using key levels people would buy and sell based on price, where price is at. Is it at a high, is it at a low? All these different types of things. Because that's what it is, right? You're just buying and selling based on previous data, previous history, okay? So to answer your question, don't get too worked up about all these different concepts and ICT and smart money concepts. Even with me, like price action, don't get, just, understand what is actually happening. Price tells a story, and just follow that story, and don't predict the market, just react, okay? React from what the market is telling you. You're not gonna be right all the time. I'm never right more than 50% of the time. I lose more than I win. I think that's what most of you are trying to do, is you're trying to be right most of the time, because I understand it's a humanly thing to not want to be wrong. But as soon as you get used to being wrong and you become a profitable loser, that's actually a thing, okay? Get used to losing. You're gonna spend most of your time in the industry losing trades. So just get used to it. Get used to losing these trades, because once you get past that hurdle, that's the next thing you need to do. So I hope that answers the question. But yeah, I want to start answering more of these questions for you guys. So make sure you do leave questions in the comment section. Don't make it stupid, just make it nice to help other people as well. But yeah, guys, listen, I'm gonna head off now to bed. Hopefully you guys enjoyed the video. Make sure to like, comment and subscribe. I'm trying to reach 100K subscribers as soon as possible, because that would be insane. I'm gonna try and be consistent. Make sure you share it with friends. And if you want to join my Discord, link will be below. If you want to join the Copy Trader, where we trade for you automatically, link will be below. And yeah, guys, listen, thank you so much for watching. I'm happy to be back, and I will see you all in the next video.